All right, folks, welcome back. This is our midweek review. It's going to be a little bit relaxed this time. I'm kind of going to buzz right through this a little bit quicker than I normally do. The Bitcoin market, if you are a Bitcoin trader and you have held long positions, I've already posted on my community tab on my YouTube channel. If you have not taken something off at 52,000, you're really being foolish. This thing has gone up so much that while it could go higher, it could. No one knows where it's going to go. But if you don't take something off here, I would I would, okay? I would definitely take something off here. Okay? But what do you do if it is making the high and you didn't take anything off? That's always a question. We're at all-time highs. It's never been here before. It's climbed a lot. And while it could still go higher, it might take a long time to do that. It might take several years. Or it could just keep on plowing up higher. Either way, paying yourself along the way is, in my opinion, the best thing to do. But ultimately, I know some of you just think this thing's going to go to 1 million. And nothing I'm going to say is going to make you see any plainer than what I've already been preaching. If you don't take partials along the way, don't let greed, okay? Don't let greed put you in a state of mind where you think that you have to have every part of your position on and capture the whole move, which you don't know the end of. Because if you think you know where this thing's going and you're holding for some other target higher than this, what makes you think that? And how are you going to know when it gets there to take profits or sell some of it? Don't be foolish, okay? I don't preach crypto here, but it went to a level I mentioned on my community tab. If it goes higher for an intermediate term, higher price swing, 62,000's where I would think it would go. I am not of the opinion of 100,000 Bitcoin for this year, and there's a lot of people pumping that idea. If it did, then hey, I'm wrong. I just think this is too much ground too fast, regardless of how many businesses are starting to pour into it, allowing it to be used for their services and such. It just feels like it would be best if you took something, okay? And I'll just leave it to you if you want to listen to that or not. But and how much, I don't know. But you can always buy back in it if it's going to go higher longer term, but you can never get back to the ultimate all-time highs. And there's a lot of people that regretted that and suffered all the way from 19,700 down to 3,000-ish. So it's just something to consider. All right, let's go over to the dollar index and see what this is doing here. I have a couple students to thank. I'm obviously probably not going to name all of you because there's a couple dozen of you that actually sent this idea to me, and I'm so thankful that you guys do that because I'm not a expert with TradingView. I do enough to try to do the videos, and then I work with my own charts that is not TradingView. Okay, and I know some of you are going to be asking, what is that you're doing? What are you looking at? I use TradeStation, and no, you don't need that to do any better. There's no advantage over it except for I'm just used to doing it. Okay. All right, so we're looking at the dollar index. This is a weekly chart, and the folks that helped me with this tip that I'm about to show you, there's a lot of you that actually sent me this. Some of you actually sent me videos and tutorials and such. And just as a mental note for everything going forward from this point on, I don't open up file attachments. I just don't like to do that. I don't know if someone's sending me something with a virus. I don't open up any of that stuff. The idea of sending me a chart, if you have a question about something, do not send it to ICT mentorship inquiries at gmail.com. That email address is only being used for people that are tipping me off and my staff on folks that are leaking the videos. That email that you're looking for to send me any correspondence as a student is innercircletrader@gmail.com. Okay, and if you want to ask me a question about something, just know that it's probably going to take me weeks to get to you. And by me putting this in a video, it's almost like I'm asking you to send me emails when I'm really not asking you to send me emails, if you catch my drift. So, but if there's something that's really pressing you and you just can't get past it, I understand that's going to come up, but just try to endure to new content and new commentaries, because I'm probably going to touch on it. And there's so many of you that came in the first month that already experienced this. You send me an email, and then a day or two later, I haven't responded back to you. And then you're like, don't worry about that. I got the answer in this video here. Okay, so I meant that when you guys first joined, you have to be patient, because I know what you're going to think as a question. But I also know that that answer isn't necessary for you right now, even though you may feel that it is. But if it is a question that's just keeping you up at night, you can't handle it, you send it to innercircletrader@gmail.com, and you include your user number for your account. Okay, so your user number, or username rather, I should say. If that doesn't accompany the email, my staff isn't going to push it to me. And if they're not pushing it to me, I'm not seeing it. There's just too many emails coming into those email address, and I can't keep up with it. So I don't take any of my time in the day to go through this, unless I'm, literally looking at my phone and something pops across my phone, says, this email came across, and it may be an urgent thing, and my staff isn't technically on call at the time. I'll try to field it, and if it's something I can fix or address, I will. But most of the time, the emails come to me by way of the order that they've been received, and if they have been sent with their username. So without a username and it doesn't match your email address, my staff will not push it to me to address. So is there another email address that you can get to me sooner and quicker in front of everybody else? No. So please don't ask me that. The idea of sending me a chart, you can create that on TradingView with this little thing here, little camera icon. Click on that. If you click this, it'll give me a link that'll open up this chart right in TradingView. I don't mind opening those up, but if you send me a file or a video, unless I'm expecting something from you and I've already had correspondence with you, I'm probably not going to open up your attachment. I've already had people try to send me stuff, and I just don't do it. So anyway, a lot of you that are in here sent me instructions on how to organize the annotations better than what I had already submitted. And to be honest with you, I'm really thankful that you did it, because it makes what I do even easier. So I'm not against learning something like this. Trading stuff I'm not interested in. Please don't tell me what you're doing trade wise and you're trying to correct me or tell me what you do and profitable. I'm not interested in any of that. Okay, so just know that while I'm open to learning things like this in this platform, I'm not interested in your trading plan, your trading techniques that's outside of what I teach. I've been around enough to know that I don't need to look at anything else. I have what works very well. So let's keep the conversations like that. So the idea of managing the annotations is a little daunting for some of you. I don't mind, and I didn't mind actually going through and hiding the things that I would use in my conversations with you in these videos. But if we were to look at this chart here, you right click on anywhere on the chart and you go to object tree. Now this is assuming you have annotations, but what I did was I started with a clean chart on the weekly, and then I put every annotation on that I wanted for the weekly chart. And then once I had an annotation, I highlight it over here, because once you put something on the chart, it'll put a like an icon over here for that particular annotation. So if you clicked on it, this little folder icon will light up and it'll allow you to create a group. And if you just drag and drop every annotation in that respective group, you can see here I have DXY, which is dollar weekly, and I'll scrub this over a little bit so you can see what it says. Dixie or dollar index weekly notes, and then Dixie or dollar daily notes, 60-minute, 15-minute, and 5-minute. Now I was using the templates up here, okay, the little things that you can save your charts as, and this is actually better because if you recall, I mentioned that if you create a chart that just tracks all of the fair value gaps, you can do that. I don't have it here. Okay, I don't have that here to illustrate, but I'll show it to you this weekend as an example. But every time frame, I would open up the chart for that particular time frame, like daily, and I would put any annotation I felt that was salient for that particular time frame. And then I dropped them into its individual folder, and then I named it or renamed it to what I wanted to call it. So everything in this here is the daily annotations, the 60-minute annotations, the 15 and 5-minute. So if I want to drop into any one of these time frames and I don't want to have all of the clutter that may arise by having all of these lower time frames, then I can just hide them all collectively. And I thought that that was really, really good. And Calvin, Corey, Michael, Thomas, Jan, I thank you very much. And no, I probably didn't name all of your names, and I don't mean to offend you, but there was a lot of you. And truth be told, I mean, everybody else, I saw the same kind of like emails that I've got from those folks. So while I'm not any less appreciative, I'm just as appreciative because I may not have received those emails from the folks that actually sent them to me. If you have a tip that you'd like to share with me and I can make it available to the community, then by all means do so. You can send it to me in an email to innercircletrader@gmail.com, and in the title of the email just say, TradingView tip, and I'll look for that, and I won't open anything else because my staff usually goes through everything else. But I'll go through the emails and try to look for those every other day or so. If there's something there, then cool. If it's not, then and I'm not missing anything, am I? But I really appreciate you guys sharing this tip with me because, as you'll see, I think it's pretty awesome how you can group everything in all in one time, remove it or put it back. But for the weekly, if you wanted to see the annotations for the weekly chart, you just click on that and we'll zoom in here. There's a small little fair value gap in here. This is the sell side and bounce buy side inefficiency that remains, and it's a small little portion right above this high. Now, I'm personally not of the opinion that we created a long-term low here and it's going higher. I don't personally see that right now. The commentaries, I told you I was going to veer off course and stop talking about where the market's going to go because that was not promised to you and it's already been abused. There's a couple people on YouTube that are doing mentorships, and because I clammed up about euro dollar, amazingly, they don't have an opinion about euro either. Well, that's very convenient, isn't it? So I can teach you all how to do this without pointing to where it's going to go to next. Okay. I will go back into that at a later time in the year. I'm not promising as to when, but it will resurface, but it won't stay constant. I'll do it when it's necessary. Right now, it's not necessary. You have a lot of things to learn. If you are of the opinion that you don't like this style of teaching because you got spoiled coming in the door, I reminded you that I'm only showing you that just to reassure you that I can do it. But because I can do it does not mean or obligate me to give it to you on a silver platter, spoon feeding you every single day, every single week, what it's going to do next. That I'm not doing. I'm making a lot of 20-year-olds look really, really smart right now on Facebook, on YouTube, and Discord, and Telegram. Yeah, I know all about you guys. Okay, so I'm going to give just enough. That way you're learning, but you're going to have to earn your own street cred because I'm not giving that to you anymore. So feel free to unsubscribe and not go to month 2 if you're mad about that because I didn't promise you that. But you won't be here to get to the stuff that I have after we get through this mentorship. All right, so anyway, if I'm wrong, okay, let's say I'm wrong and we go higher, this is where I think it needs to go, if at all. I don't think that it needs to go there. So listen to me carefully, because I got an email, a screen capture of somebody else. I don't know who the person is. I don't know if they're in mentorship or if they're just watching a bootleg version of something or whatever. But they said that I was wrong all week. And when I commented on my YouTube channel saying that Eurodollar and cable went to my targets, be content with that, that I've been wrong. No, it went to where I outlined. I said that we'll see if the Eurodollar wants to go up into that fair value gap on its daily chart, which we'll cross that bridge when we get to Euro. But it traded to the liquidity pool. That was my target. That was my objective. Then I said, we'll see if it wants to trade up there. I'm going to elect to watch and see if it wants to do that. Now, that's not saying I'm buying anything. I didn't take any trades. I haven't done anything. So if you choke on these times where the market does something that's relatively unexpected for you, and you think right away, because I didn't talk about it, I'm wrong. Again, you are looking at right or wrong, profit or loss, binary. You're thinking binary right now, when that has nothing to do with your learning. You need to understand principles, time, and price theory. If you don't focus here right now, all that other kind of stuff, there's going to be moves that I'm going to miss. I've already mentioned this. You're going to miss moves. And I'm not going to come in here and try to give you the impression that I have an answer for everything, because I don't. I don't have an answer for everything. If there's something in the chart that makes sense to me, then I'm going to point to something and say, this is what it's doing and why it should have been bullish or bearish around this time. But if I don't have something, I'm going to tell you, I don't have it. But I also talk about where we go into liquidity pools. If we trade below relative equal lows, or if we trade above relative equal highs, it's reasonable for you to anticipate a retracement, if not an altogether reversal. I'm stating that while we had a very short-term 2-day rally here in the dollar index, that to me is not convincing enough that we've created a long-term low down here and that we're going to go higher. Okay, and some of you are looking right here, saying it's going to go right there. Some of you are pointing up here already. Man, that is really, really overzealous. Like, I don't even call moves like that. I don't do that. So I want to look at what we've done, and so far for the year, we haven't done much. We're still in this tiny little range here. Nothing's really happened this year so far. I don't think it's going to stay like that. But it's important for you to remember that, we're looking at a weekly chart, and there's nothing in here all that exciting. Nothing has created an imbalance in here. There has been no run on liquidity on a weekly chart. It hasn't done anything. Nothing. So all you're seeing on a daily chart is a little bit of movement, and you think that's the big boys moving. And they haven't done anything yet. They have not done anything at all. There's no trading going on the large fund level yet. Not in the scope that we would use for displacement, understanding where we are in terms of order flow. All you're doing is looking at a small little reaction that came out of nowhere. There's nothing fundamentally driving it. So it's just an oversold condition that they're trying to pump it up into a premium. Now, if it takes out this fair value gap premium high, I know that I want to see it go to here. That offers me range. Not much, but it offers me range. But it also gives me a context that if it trades up to that level in here, that might set up a short for me. Whereas right now, nothing is lining up for me for a buy or a sell, because we are stuck in a range. Remember, when you came to this mentorship, you have no idea what you were coming in to learn. I do know what you're learning, or if you stay here, what you're going to learn. It's primarily this chart is what you're learning. I'm teaching you to trade with this chart, even if you are an intraday scalper. This is the chart you're trading. I'm teaching you to use what's the likelihood of this individual weekly candle being bullish or bearish. So my question to you is, if you are so animated or upset or scared that you missed something, Okay. What is this chart telling you in terms of the weekly range? Is the weekly range going to keep going up? Is it going to go down? Has it made the high and low of the week? Is it going to consolidate? Can you get that information from this chart? Because it's not there. None of that information is here. It's still 50-50 either way. So is that high probability? No. So if it's not high probability, now I know some of you in here that are new, first month guys. You're sitting there thinking, oh, this guy's coming up with some kind of crap now. He's talking his way out of something now. Listen, when you get to the next lessons, okay, when you get to the next threshold of understanding, you're going to hear me in the back of your head saying these things, and then there's other parts that will come together, and you'll have that epiphany. You'll say, oh yeah, well, I didn't understand it at the time, and I thought it was just, nonsense and gibberish coming out of his mouth. It really means something, right? The idea that this market is predisposed to go higher or lower right where we are right now is just a guess on your part if you think that. There's nothing in here at all, absolutely nothing suggesting there's a low formed. There's nothing in this chart suggesting that a high is ready to unfold either. So when I point to the relative equal lows in the dollar index in the intraday chart, I said, this is where it's going to likely draw to. That's what I said was going to happen, and it happened. That's the only thing I can work with because we're inside this consolidation on the long term. So there's no real displacement caused by large funds. Large funds create the order flow. The central banks provide the liquidity to them. That order flow, that's the wake. Okay, kind of like if you're surfing behind a boat. Okay, you're riding on those waves. You need that displacement of the water. You need that motion, that movement. Otherwise, you're sitting still in the marketplace and you're losing money probably because you're throwing money at something that isn't there. It's not going to carry you anywhere. There's no tide. There's no movement. There's no wake. So if you can't find that, what do? You sit still, you relax and wait for it to happen. Don't panic. Don't overthink it. Don't worry about it. But I'm teaching you how to read these individual candles. And if these candles are going to provide an up candle when we're in a consolidation, well, I'm generally long-term bearish. Like I'm still bearish on dollar. I'm not bullish at all. I've not changed my mind, and this chart has not done anything to undermine that idea. If it trades higher, then that's fine. I'm wrong. But I'm trying to teach you that there's nothing here that I see that would warrant that idea of seeing higher prices in dollar where we are right now. It's not there for me. And if I was forced to take live trades on my opinion right now, and I took shorts, which I'm not ready to do, short dollar, and I would lose money. Why is that a surprise? You're going to lose. You're going to have losing trades. But because I understand that the likelihood is there that I may lose in this environment, I hold back. That's wisdom. That's experience. That's what you're trying to obtain from me without hurting yourself. And some of you have learned the hard way this week. Again, more people sending me emails. Hey, I got burned in Eurodollar this week. Okay. What did you learn from it? You should have learned I shouldn't be trading right now because that's the number one rule when you came in here. Don't trade with live funds. Second rule is if you're trading with a demo account and you just started, you're doing it wrong too because you haven't even learned what you're doing yet. You're supposed to be paper trading after you've observed. What do you observe? The things I'm teaching you, time and price, how these kill zones create the turning points intraday. And then, as I'm going to talk about today in this video, what you do with that information that will help you test yourself in the first lesson in month 2. So anyway, the idea of looking at the charts like this and grouping everything here, it's just really, in my opinion, it's the best way of doing it. What I was doing was inferior compared to this, and I want to thank you all that shared this idea. All right, so we're going to drop into a daily time frame because I'm spending already way too much time here. All right, so this is what everybody's all excited about. Like, oh, what is this? It's going up here. Well, it could. I guess it could. I don't see it there yet. I don't see that. I see that there are opportunities where it creates this type of movement here, and you see that gap, and you think it's real explosive, and it's going to probably keep on going up. But it's really no different than what it did here. Gapped, started the run, and went lower. And while it may not look exactly like that, this is kind of what I anticipate. Because if you look at what we've done, again, for the year, we're here. January is the low here. And we created the yearly high for 2021 here at a level we were anticipating. It sold off like we were expecting. The relative equal lows, and here's what I put your attention to on dollar. Well, if it trades below relative equal lows, and the range prior to this decline is this low to this high, aren't we in a discount? Yes. Just because it's having a retracement higher, does that mean it's going to take out this high? Not necessarily. It could just as well go up here and touch the bottom of this fair value gap. That's from the weekly chart. It could do that and overlap with the bearish order block, optimal trade entry, and then sell off and attack this low. That could be what it's doing. But I don't see it in the chart yet. It's just an idea right now. It's a scenario that may be something I look to frame an idea or a trade. You're not going to have all the answers. I'm not going to have all the answers every single day. That's not going to happen. Okay. When it's highest in probability, lowest in risk, and it's the most easy low-hanging fruit approach to trading, that's what you're learning here. That doesn't equate to everyday trading. It does equate to about an average of 1 to 2 trades a week. But that's what you're learning here. But in between that, you'll learn bread and butter intraday setups that help you practice, and then you can make a model out of that and do whatever you want with it. But the idea of it getting all animated about this right here, there's no reason for that. So if we have the weekly data here, I'm going to add the daily now. Okay, and what we're showing here is the bearish order block, which it traded up into. And it's an overlap and consequent encroachment of the weekly fair value gap. And we have the relative equal lows here, which we went down below yesterday and then reacted. And we haven't traded back up to the bearish order block yet. So that's the levels I have here. So if I take the weekly data off and just show you what the daily looks like, that's all I have. That's all I have. That's all I'm interested in. Weekly and daily back on. And we're going to drop down into the hourly chart. All right, so the hourly chart, here are those relative equal lows. And I mentioned that the sell side liquidity below that is what it would most likely drop down into an attack. It did that, okay? I'm not wrong in that regard. I'm not trying to save face. I didn't say I called this move. I'm saying it went down to that liquidity. It drove into a level that we would look for. If we have a objective where it's going to trade to, like this liquidity pool here, okay? If it trades there, your expectation would be, okay, if I was hypothetically in a trade, I would take something off there. And let's say that you were, we don't short or go long in dollar, but let's assume this was a currency pair that you would have been trading. And we were looking for it to trade lower and went down here and you were short. You would be taking a partial off there. Some amount of that original position. How are you upset if you've done that and it does this and ultimately takes out the remaining portion of your trade? You have profited with the idea and logic that you're learning here. Some of you, and when I say some, it's just one guy. One of you in here are upset that you didn't see and I didn't point this move out. When if you spend time with me and you go through the course, you're going to see that this relative equal lows and a run below that, that is a trade. This is an idea. It's a purge and revert. You just learned about that on YouTube. So again, I'm not going to hold your hand and give you trade setups. And I don't care if you're mad about that. That was not promised to you. I'm going to teach you how to see these things, how to look for them, how to anticipate them. But the main thing you need to appreciate right now is the fact that you're learning how to navigate in a very difficult market environment, because it is. You might be looking at 1 minute, 5 minute charts and thinking, man, this is the greatest thing in the world. Yeah, there's movement on those time frames, and yes, you can make money, but you haven't seen anything yet. Wait till these daily chart time frames and the 4-hour charts start loosening up. Man, we're going to have all kinds of opportunities. And to answer your question that came up earlier when I said I would go back into talking about where it's going to go to next, but it's not right now. That's what I'm waiting for. I'm waiting for these higher time frame daily and 4 hours to have displacement and loosen up, and then I'll have a little bit more clarity, and I'll point to things. And I know I'm going to get ripped off. I know there's going to be everybody on their pretend mentorship courses that they're going to repeat what I'm saying, and they're going to look smart then. Okay, but just know that as a steady diet, the rest of you in here that are trying to learn it, not rip people off and pretend that you're smarter than you really are, you're going to learn a skill here by doing it this way. And once you understand it, once you learn it, no one can take it from you. No one can minimize it. No one can reduce it. And it'll give you a great deal of confidence knowing that you have that skill set to lean on. You don't need your job that may be redundant. Look around. There's all kinds of things happening in the world, in the United States. Crazy stuff. Things you wouldn't have expected in the U.S. You know, there's people in Texas right now suffering. I would love to go on a rant right now and talk about what I think is going to happen, but I can't. Just know that I think there's something wicked at foot down there, and they're putting the screws to them, basically. It's a punishment. So if we look at the hourly notes that we have here, so I have the daily. This is that bearish order block on the daily. And this is the hourly chart annotations. You can see we had this big run up in here, down close candle. That's your bullish order block. And then we gapped opening, trades back down, fills in the gap, hits the order block, and rallies. And it's occurring inside of a bullish breaker, which is the low, highest up close candle at the high, and the lower low. This is the run on that liquidity. This is the thing I talked about where it was going to go. Okay, it went there. Once it went into that sell side liquidity, all of this movement here, well, does this look like it's bearish at the moment right here? No. Is it bullish? Not necessarily. It could have gone either way. But when we see a gap opening, it creates a gap and comes back down and shows a willingness to want to rally inside an area where we would anticipate bullishness by itself. It doesn't mean anything. But if you start seeing things like the gap higher, remember, gap opening higher, if you're bullish, that is a positive signature that you are likely to see a tradable run after it fills the gap. Or maybe it goes in half of the gap and starts to run. Then you start looking at, does the institutional order flow support higher prices? And when I say that, institutional order flow is defined by support of down close candles. When price touches the down close candles, that operates like a bullish order block and sends price higher. If you keep seeing that, that is institutional order flow that is bullish. And you keep expecting it to keep doing that until it hits some higher time frame premium array. And it could be an hourly chart, could be a 4 hour, could be a daily, weekly, or monthly. It just depends on where you're at in that range. Now, you're going to ask, what range should I work with? Well, that's part of what you're trying to frame for your own model, because you can look at dealing ranges just on 60-minute charts, and that's your definition of the dealing range. And you work within that particular dealing range for your model. And you don't necessarily care about the dealing ranges that would occur or form on a 4-hour chart or daily or weekly or monthly, but you use those higher time frame charts to get a bias of what it's likely to do over the next coming weeks. Is it likely to keep going higher? Is it likely to keep going lower? And you use those higher time frame charts for that purpose. You don't try to demand more than that from them. The order flow from an institutional standpoint is best derived from the weekly and daily, and maybe 4 hour if it's not so clear on the daily. But 4 hour isn't all that much different from what I've already shown you here, so it hasn't provided any more greater insight, and there's no necessity for me to start bringing in the 4 hour chart because we already spent too much time on the time frames I'm referring to here. But you're certainly welcome to cycle through them, and even between 4 hour and 1 hour, there's a myriad of different time frames you can set with TradingView. Now, you may not be able to do all of it because of you might have a basic plan, and I'm not a master of what is available on each policy or plan for TradingView, and I'm not trying to sell you on it because I don't get anything for it, and I don't think you need it either. But the idea of looking at different time frames, don't let me give you just these time frames, but you definitely study your own charts with these time frames. Now, that also reminds me that I didn't give you the opportunity to test yourself, but just give me the liberty to talk a little bit how this has been helpful in my opinion, and how it might be helpful for you with managing your annotations. So we'll go back to the same style I've been doing. I know some of you are probably thinking, I like this is better. The charts are bigger. Well, it's only because I'm only doing one copy, one rendition tonight. And I know that it might get spread everywhere and whatever. But the point is, it's only one video tonight, and I'm not making multiple copies of it because it's right now 6:43, and you can see that time down here. So by the time I get done, it's already going to be late. So usually I make 25 different copies of the same video. I don't have the time to do that today. So it'll just be this rendition, and then we'll all be happy with it, I'm sure. So anyway, the gap higher indicates that it's likely to keep going up. If it fills the gap and rallies, we have it. Bullish order block in here trades down into that, rallies. Down close candle, it trades into that and rallies. So it's offering, and even this candle's high, it does it here, trades into it, and then we have this. So this has been bullish institutional order flow, at least for the hourly chart. We have a fair value gap in here. If it overshoots that, we can see the order block retraded to here. Does it need to do that? I don't know, but we'll see if it does it tonight, and we'll see if it wants to get into that bearish order block on the daily time frame. Dropping down into the 15-minute time frame, I'm spending way too much time talking about everything else, but this is your 15-minute time frame, and I'll add the annotations for the 15-minute time frame. All right, so here is your breaker here, and we also have a fair value gap, trades down into that. Now I'm going to zoom past this, but you've seen where it was derived from. Gap, imbalance, trades back down into it, completely fills in, overshoots it a little bit, that's fine, order block. Optimal trade entry, rallies up, fair value gap, and we're sitting at that, almost filling in there with the daily bearish order block. Now let's assume for a moment that it was too much information on this chart, okay, and you didn't want to ring in the daily. It's getting too many things on the chart. Not that that's changing all that much. Just toggling that little eyeball, okay, does it. And you can take that off there. So everything is real easy, click, and it's gone. But if you don't want it on there, you just click it so the eyeball has a slash across it. To me, I think it's wonderful. I mean, this is such a wonderful application of organization. To me, it's perfect, really. So this is what the chart would look like. And then 5-minute chart for your daily log entry. And we'll add the 5-minute annotations. And take the hourly ones off. All right, so we have right in here, I'll take the 15-minute time frame off too. We have order block, fair value gap, trades into it here, at London open kill zone, optimal trade entry here, starts to run higher, consolidates inside of the mitigation block. Mitigation block is this last up close candle. Now in its entirety, you would use the entire range low and extend that out. And the reason why I didn't do that is because I have this New York open annotation there, and I didn't want to move it too far low. I wanted it exactly the way it is. And yes, My obsessive compulsive disorder is that. It's that annoying for myself even. But you would have this entire rectangle laying all the way on its low of this up close candle. That would be your mitigation block. It trades into it here, 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 and in New York opens when it matters, runs. Now I want to talk a little bit about take the daily off so you can see that up here clean. See how nice that is? It cleans it all up, but it's all there still at the click of a button, your daily bearish order block. But I want you to look at the turning points that occur in the kill zones, okay? And I said yesterday that I would talk a little bit about how you're supposed to be looking at what you're learning in month one, because for some of you may not feel like you're learning much, because maybe you've seen this kind of thing in my YouTube videos, maybe you've seen this kind of stuff, in my Twitter, maybe you've seen other people doing it as a student of mine. But what you're doing is the actual work of annotating your chart. And the fact that you're annotating, hopefully you're annotating and not just looking at mine and collecting mine. But if you don't do this each day and get the experience of seeing how it happens, how often does the market run and create a 20 pip run or a 30 pip run from that low or that high in London? How often does it make a 20 to 30 pip run in New York in the same direction that London started creating? How often does it create consolidation in New York even if London Open had a run higher or lower? In other words, if there's a real clear, easy trade that you can see in hindsight in London, but then it goes consolidation during New York going into London close. I'm not saying that's the case here, but how often does it create quietness? How many opportunities each week and across the entire month? How many opportunities do you see by going back to your charts where there's an opportunity to trade? Now, I'm not trying to coerce you into trying to trade every day, because what you'll learn in month two is how you can begin to pull out the better days to trade and leave the other trading days to other people to trade. They may create opportunities that if you look back in hindsight and say, I wish I would have been in that one. If you think that, you're going to be you're going the wrong direction. You don't go where you're trying to get to by staring in the rearview mirror. You just don't do that. You can always look at rearview mirror constantly and think about, I wish I coulda, I wish I woulda. It would have been better if I would have did this or that, by looking in what already happened. But you can't do that here. You learn from your mistakes, you learn from the opportunities, but you don't beat yourself up about it, and you keep going forward. Using these turning points with these specific intraday time periods, London Open, 10 o'clock to noon, New York time, 7 a.m. to 9 a.m., New York time, New York Open, 2 a.m. to 5 a.m., New York time, local. If you have a live broker and you've been looking at those charts, you want to kind of keep looking at TradingView, because the lessons are going to come from this. But wherever you are in the world, you need to figure out what TradingView time is in your local time. Like when you set your time on TradingView, it needs to be set to New York. But your broker probably isn't set to this time. It's going to be something else. And there's so many opportunities for it to be something else that I can't go through every possible scenario. So the way you calibrate your time with your broker is to simply look at what time it is on an hourly chart on TradingView with it set like this. Okay? And then find out what it is in your local, or not in your local, but with your broker. And then go backwards on the hourly chart, or go forward in the hourly chart, wherever you are in time, in your global position on the earth, in relationship to the time on TradingView. And if you find the midnight candle on an hourly chart on TradingView, find out what that candle is in your platform, and whatever that opening price is, you draw that across your intraday chart. And you'll have that filter that I use that isn't shown in this chart here. But it's this one here. So whatever that opening price is, and it just happens to be 90.64 and 3 pipettes. That's the opening price. You would draw it out in time. That would be opening price. Now that's not going to be the same exact time in your broker, but it's the same time that you need to be worried about, because whatever the time is in New York, that's what the algorithm works off of. Oh, you Americans think everything revolves around you. I'm sorry, but it does. It revolves around New York time. Okay, so everything resets at midnight here. I know all these other guys that make these courses say Wellington starts the new day. No, it doesn't. Okay, that's not true. It's New York. Okay, New York starts the whole process. All right, so I promise you, I know more than a firefighter. I know it sounds arrogant, but everything runs on New York time. It doesn't begin in Wellington. It doesn't begin in Asia. It doesn't begin any other time. Midnight New York time. All right. So when you look at the turning points after you frame the day at midnight to 2 o'clock in the afternoon New York time, I'm framing this each and every day because I want you to see, if you do this, you're going to start seeing how the daily range forms each day. It's not imperative that you understand which direction right now in month one. That's not what you're trying to do. All you're doing is observing. You're doing little labs every single day. A laboratory experiment is what I'm referring to. And you're trying to see, does it create a important high or low in the London Open Kill Zone? Does it do it here? Sure it does. Does it create an important low or high in the New York Open? Sure it does. Does it create an important high or low in the London Close? Yes. Does it create the absolute low of the day in London this day? No. It starts off down here, a little bit lower. But even if you don't get this low, this is what you should be taking away in your month one, and not tricking yourself with what you think you should have seen or what you could have had. That's irresponsible with what you're learning. Instead of saying, this is the better buy down here and this is what you should have been trading ICT. No, I want you to focus on 2 o'clock to 5 o'clock in the morning for right now. We'll get more into these types of setups later. But for now, all you need is one of these or one of these once a week. That's it. If you bought, now permit me some liberty here, okay? Because I don't generally like to talk like this. But let's assume for a moment that you've been here for the full duration, 13 months, then you did 6 months of demo trading. You found consistency, you found continuity, and you're not making silly choices and emotional responses and just rolling the dice. You have a real measured approach to your specific model. I'm not saying every one of you will reach that 6 months after you become a charter member, but that's reasonable. That's the low end. That's where it's at. So what does that mean? That's 19 months, folks. 19 months. And some of you aren't prepared for that. That's realistic. Some of you are in here with more experience, and you're going to see things in here that's going to right away jump your understanding up. And maybe you've already been profitable trading, but now you've seen something in here, or you'll go into a lesson in the coming months and then be like, oh my goodness, this is it. This is what I'm looking for. I'm not saying that can't happen, obviously, but I'm speaking to the neophyte, the person that has never traded with live funds or tried to and blew their account. I'm not laughing at you because I'm just thinking about how I did that stuff too. I did that. There's no shame in that. Why would you expect any other result? You didn't know what you're doing. If you get to the point where you know what you're doing, how you're navigating through this, what your model is, what tools you're going to use that I'm going to teach you. Not every tool is applicable to every single model. It allows you to gravitate towards particular approaches to trading, and it may not be the one you think you're likely to trade when you're done as a charter member. For instance, some of you want to be intraday scalpers and go crazy, and you may discover that short-term trading is probably better for you. or long-term position trading or swing trading. Don't hold yourself to that initial expectation coming in here. Be flexible, because if you aren't flexible, you will resist going into where you're better suited, but you just don't know it yet because you haven't learned the skill sets that would operate very effectively in that area of trading. And there's a way of doing it. The only ones that have the limitations are the long-term position guys. Okay, the folks that want to trade long-term position, you're kind of stuck. Like you know, there's only so many things I can teach you to do that. But if you want to operate in intraday in any capacity, I got all kinds of stuff for that. Short-term and intraday is just like, I got models and trading plans for days for that. Like I can do all kinds of stuff with that, make you crazy with that. But long-term position trading, it's kind of like one-trick pony there, and I can give you a couple different ways to work with it. But I think even if you think that's your cup of tea for right now, you'll outgrow it. You will. You'll make changes in your life where it will allow you to do what you probably aren't able to do right now. But I want you to focus on these times of the day and see how often it's making these turning points. Now, how often each week does it give you really choice setups? Where if you would have been a buyer down here, okay, say you were a buyer, you were trying to buy the midpoint of this gap. Maybe you didn't think it was going to go all the way down here, but you just bought the midpoint plus the spread. Okay, so you went in there around 90.73, you'd be bullish dollar. I'm not saying we're trading dollar. We do not trade dollar. We use it as a barometer, as a way of measuring the order flow in opposite that what we would expect in the euro or cable. Okay, in other words, what we expect in euro dollar or fiber or British pound versus US dollar or cable. We want to see the mirror image of that occurring in this price on dollar. If we have that, then we have symmetry. If we don't have that, then we have to go to the crosses like euro pound. Because if this is consolidating, then it's going to be using the euro versus the pound to make the euro pound move. So as long as the dollar is likely to trend either higher or lower, we don't care, then we should see euro and cable moving in tandem in the same direction, closely, what we would expect to see both of them trading. In other words, both of them should be moving lower together in concert with one another while the dollar goes higher. But if the dollar's going consolidated, then the first thing you do is you think, okay, I got to check the crosses. And what is euro pound likely to do? And if the dollar index is likely to trend, I never worry about euro pound. I don't even go there. The catalyst for me to go to the euro pound is dollar index consolidating. Okay, so you just got a tip right there, but you probably won't appreciate it until you're in month 4. But it's there now. But you want to study what drivers were part of this particular day at this time. That's the economic calendar. And by studying the past 4 weeks, when we complete the month of February, you want to go back through your daily log entries and look at the economic calendar on those days that had the best moves. And you're going to find that there was generally a medium impact or high impact news event that occurred at the time or later on in the day, and they used that drive into it to set sentiment, and then they reverse it when the news driver comes out. The news driver is whatever the economic calendar event is, which is the reason why I bring it up every single time we talk on the weekend commentary. I didn't bring it up today because you can see we have a whole lot of jawboning to go to. So anyway, just study how often it creates these price runs, and over time you're going to start seeing these reoccurring things that you don't necessarily see right now, but because of repetition, you're going to say, oh, I keep seeing, every time he shows these charts, I keep seeing this thing that keeps lining up. And what's going to happen is, if you just would have listened to me on YouTube years ago, because I did this part on YouTube. I did this. I told you all to do this. I did it in my free teachings. But many of you came here and still didn't do that. You watched me talk about it, but you never really did it. But because I'm doing it with you, you're seeing the benefits of it. You're like, wow, it's really there. But you would have known that 10 years ago. 10 years ago, some of you folks have been watching my videos and you've never done anything with it. And it's always been here. It's always been in there. Now, you're going to learn obviously a whole lot more than what those videos talk about on my YouTube channel, but it's important for you to start here. And that's why I force this perspective on everybody coming into the door. When you come into this mentorship, you have to have this. And to make sure you have it, I force you on it in the early months. So for first month, what should you be measuring in terms of what you learned or what you're learning? Well, how often it creates these price runs at these specific times of the day. If you do that, it gives you context to know when a trade is likely to form and what do they look like. And your trade of choice, if you do this every single day, minimum 6 months, you're probably going to start seeing your particular setup that you like, because it'll jump off the chart at you. There's lots of trades I see here in this chart, lots of them. But there's one on this chart that if you don't see it right now, if you come back to this video, and in fact, you might want to do that. Write down in your study journal this video, and right now, the minute marker where I'm saying what I'm saying. And then when you become a charter member, come back to this video and you're going to see your trade of choice in this chart. It may not feel like it right now, but I promise you, you will come back to this chart and say, yeah, that's my setup. It was there, but I just didn't see it because I didn't learn enough yet. And it didn't materialize or manifest itself in my studies. Some of you will see optimal trade entry. Some of you will see institutional order flow entry drill. Some of you will see a breaker. Some of you will see a mitigation block. Some of you will see a imbalance completely closed in. Others will see the next thing I'm going to talk about, which is the redelivered rebalance. This candle trades up, opens down here, the next candle runs right on back up again. So we completely ignored this wicked candle and we used the one before it. That's here, and the next candle after the run up. So there's your imbalance. Institutional order flow entry drill. There's your trade. What are you traded to? This old high for offset distribution. Well, that's not a lot of pips, Michael. We're only talking about 10 pips. Right. What happens if you do 10 pips in London, 10 pips in New York, 10 pips in Asia, 10 pips in New York, 10 pips in London close the next day? What if you take 10 pips in New York open and London open 2 more times that week? How many pips is that? You see where I'm going? Some of you think you have to capture these big 250, 500 pip moves. You're all falling victim to these Instagram goobers, okay, on YouTube too. Yeah, we just captured this 25 to 1. No, you didn't. No, you didn't. Because if you did, you would have showed it in your live account and you would withdraw it and show the bank statement. That's what you would do. These people aren't doing that. They're not doing that. They're talking about hindsight. I'm teaching you real mechanics. I'm teaching you how to go in here and find the least and how to take that minuscule amount of pips, this tiny little piece of price action, 10 pips. That's the minimum that I would ever consider. I personally like 15 pips. If I can't get 15 pips, I'm not taking the trade. But if I was to sit down and say, I'm going to only take 10 pip trades, man, I could be all over this chart, multiple different directions, all over the place. And I could take 50, 75, 80 pips out of this. Now, you can, over time, do something like that. But in the beginning, what if you just focused in on trying to find one 10 pip run each day in your study? Make that your first month's objective. Is there a logical price run every single day in the euro or cable or dollar index that offers 10 pips? Now, if you start studying like that, you're going to have a reason to be in the charts looking for something. Whereas right now, when you first came in, you're thinking, I hope he talks about whether I buy the wick or the body of the order block. You see the difference there? Everybody comes to me with that same question. Can you tell me which order block to buy? Because if you teach me that, I'll know what I'm doing. No, you won't. You won't do that. You won't do that. Because even if you did buy the order block and it starts running, you're going to freak out and not know where to get out. And you hold it too long. Or get scared and get out and it won't go as far as you could have held it. Either case, you're wrong. And then you're going to torture yourself because you don't know what you're doing. I'm teaching you how to use the smallest movement in price. And the things that you're seeing on this 5-minute chart to find that 10 pip price run, you apply that to a 15-minute time frame and you'll find 20 to 30 pip runs. Then you apply it to an hourly chart and you'll find 30 to 50 pip price runs. And you put that to a 4-hour chart and you'll find 50 to 75 pips. Put it to a daily chart, 100, several hundred pips. Put it to a weekly chart, 500 to 1,000 pips. It's all scalable, folks. It's all what you want. What do you want to do? Because I will have a tool, a model, and approach for you to do that. But you have to start here, understanding how the price is going to move. London Open is going to create price runs that create generally the higher low of the day, but not all the time, but most of the time. If you don't get it right in London or you miss it, you have a real good opportunity in New York to do what it was doing in terms of direction in London. Just anticipate that happening for the New York setup. And if it's running up to a level, for instance, if we go back to that daily bearish order block, which is that level here, it doesn't get to it here, but it retraces down into the redelivered rebalance and offers institutional order flow entry. You could be a buyer there and just offset above this high, leave a small portion on to see if it eventually gets up to that order block. That's one way of trading with it. If it comes back and stops you out, who cares? You've taken something off above here. Buying down here, getting out above here. Some of you won't see that as a model and say, there's no way I would trade that. But others in here would say, you know, if I could do that a couple times a week, that's what I want. So you can't say that what you don't like right now or that you don't feel is a viable model isn't what someone else in here is seeing exactly as their dream model. For some of you who came in here, you never thought that these types of price swings were so routine, that they happen like this. And that's what I'm getting. I'm getting a lot of feedback from a lot of the new members that are like, these moves happen at these times. Not every day, but most of the time they're happening right then. And I never knew that. Because remember, if you're looking at this price chart like this, you take all this detail off, we're back to that. Like, what do you do with that? It's the first time looking at a chart all over again. But when you add the context, everything suddenly becomes a storyline and a narrative is developed. And you can see it. It's like reading a script. And then when you understand what that script is, that's why I say it's traded and unfolded to script. Euro dollar traded to script. Pound dollar traded to script. Dollar index has traded to script. So now you understand what I'm referring to when I talk to the public, but I'm really talking to you. Sometimes they might smile and think, yeah, I know what he's saying. They don't know what I'm saying. You know what I'm saying. But it's fun to see them like, I'm with you, ICT. They have no idea what I'm talking about. It's cute, but they have no idea. But anyway, dollar index is delivered. Really nice intraday here for the 5-minute chart. We're going to go to the euro dollar. I'm going to go through this one just a little bit faster because we spent enough time already jawboning. So here is the euro dollar daily chart. And I'll add the annotations. Monthly levels. I'll drop out to, that's the weekly chart. Okay, so here's the fair value gap on the monthly. We have the breaker still with the old high back here as well. So I'm not convinced at this moment that we have created the high and that we're going lower. All we're doing in my mind is a retracing, and this could lead to a higher price run later on. I'm not trying to predict the end of this price run. This is the higher time frame, macro time frame, monthly. So it's bullish. I am not trying to pick the top. I have lost so much money trying to do that over the years. I'm okay with not getting the absolute high. If it turns, I'll know, and then I'll trade the meat of the move. I don't need to pick the very top. Now, buying lows in a bullish market, you go back in time and you'll see that we were looking for bullishness back here, and it delivered. But I am not trying to teach you, and I'm not trying to convey the idea that I can pick tops in bullish markets. That I can't do. Not consistently, I cannot do that. I can pick intermediate term lows in bullish markets, and it looks phenomenal. That's okay. But I hang my hat on knowing how to operate in the meat of the move, because that's where institutional order flow is. That's where the highest probability and odds are in your favor of succeeding, not turning point highs and lows on the higher time frame. That is not required. It's not necessary. If you drop down to the weekly chart and add the weekly annotations, we got the fair value gap here. We traded down into that. Again, nothing in here is terribly bullish or bearish. I like the idea of it staying above the midpoint of the gap, which is consequent encroachment. I would like to see that stay there and start to move higher. If it creates a turnaround in here and starts to be bullish next week, then I think we will make a run for this high, and then ultimately maybe trading up into that monthly breaker. Drop into the daily. There's that imbalance on the weekly chart, and we'll take off the monthly now and the weekly and just add the daily. This was the fair value gap. I said we'll see if it wants to get up here. Now, this is what some of you, when I say some of you, it's that one guy. Now, I said that we'll see if it wants to get up here. We'll see if it wants to get up there. Okay? Go back before I was talking like that, and you'll hear me say, now, when it bounced off this order block here and it traded up into that bearish order block, nothing says it has to trade up to that fair value gap. This could be it. That's it. For some of you, that's a model. And if that would have been your model and you've taken profit, you would have never suffered any of this retracement here, which is why I like short-term trading, because you can be in and out. And maybe if it does turn on you, it's only taking a small portion, because I'm teaching you how to take profits at logical price levels where it can intermediately or short-term change in direction and create highs and lows that may be more impactful at a later time, but you don't necessarily know right now in month one. You won't know really until a couple months after Charter member how you're going to navigate and work within these structures and price. But I'm teaching you how to get these little snapshots in price action, so that way you can study and see what starts to jump off the chart at you. And you're trying to, some of you are saying, you know, I'm a month one student. I like what you're teaching, but I just can't figure out what I'm trying to do here. I can't find a trade with what you're teaching me, because you're trying to do something you're not supposed to be doing. This is not med school in a couple weeks and you're going out and cutting on people's brains. Okay. You're not doing that. And some of you just won't listen. And it's frustrating as a mentor, because I have said these things and I've said it multiple times, and it's like you don't want to hear that. It's like you have selective hearing. You know, if you have children, you know what I mean. And I don't mean that to be disrespectful. It's just human nature. We only want to hear what we want to hear. But if you came here and you're paying to learn, you need to listen to the things I'm telling you to focus on. And if it's uncomfortable, really pay attention, because that's your subconscious trying to take you off of the course of success, because you're going to derail yourself. If you give yourself the opportunity, you will mess it up. You'll waste time here. You won't do the things you're supposed to be doing, and you won't learn. Whereas if you just do the stuff I tell you to do, in the beginning, it's uncomfortable. It's like exercising for the first couple months. It sucks. You don't see a whole lot of results, but it's happening. And then all of a sudden you start seeing gains and understanding, and your physique will change, and your posture will change, and your health will be improved, and you'll have more stamina, more energy, your quality of life will improve. That's kind of like what's going to happen here, but you got to let it take its course. And nobody figures it out in the first couple weeks. It just doesn't happen. So it's real, and it's expected for you to feel a little unnerved and maybe second guessing yourself. Am I really in the right place? Am I really going to be able to learn this? Give it some time, folks. Okay, you just got in here, but hopefully you've seen enough to know that there's things happening in these price charts that repeat over and over and over again, and you'll find your model. I'll help you. I'll guide you in that. And even if you don't figure out your specific model, I'm going to give you some to practice with, and then that will open up what it is that you want to do, because you have to dabble in all of them. All right, so here's your daily chart. Trades up into the bearish order block here. Now, originally I framed this one from here to here. That was a model idea, but we had this old high here. I said if we do trade higher, we do have a liquidity pool resting above that, but if we get short of that high, what's the PD array? It's this last up close candle, which is the bearish order block. Trades up in the mean threshold of that, and then we have this movement lower. So we have a fair value gap here on a daily. That's these two levels here. And we're going to drop down into the hourly chart now. All right, so here is that fair value gap on the daily. Premium high, discount low. Mean threshold of the bearish order block on the daily chart. It's trading into it there, and then breaks down. And let's go out a little bit here and add the hourly annotations. Buy side liquidity runs up into that, rejects it, consolidates, trades lower, trades to the discount low, the fair value gap on the daily chart, and then has yet to trade to the sell side liquidity here. And we have a small little imbalance right there. Now I'm going to take this over a little bit just so you can see how it's defined. This high, that low. Okay, so that's the next short-term objective for euro dollar. So if we do trade up into that bearish order block on the dollar index, that would allow for the sell side liquidity to be taken out, and the fair value gap may be traded to on the downside for euro. 15-minute time frame, and we'll add the annotations for that. And I'm going to maximize this chart here. All right, so we can see all the turning points here. London, New York, London closed yesterday, and then we have London open, New York open, London close. So again, right away, looking at 15-minute time frame, you can see the turning points are still there using the kill zones I'm telling you to focus on. Fair value gap in here. Let me scrunch that back up so you can see where it came from. That's that smaller little fair value gap I mentioned. Inside that larger daily fair value gap, I mentioned this yesterday, and you can see that's continued out, and it consolidates there and then leaves that consolidation. Sell side liquidity under here. The tax, it comes back up to the old low. Distribution again works the discount low here. Optimal trade entry. See that? Let's zoom in on that. Optimal trade entry with New York open kill zone here. Trades down, makes the low of the day. London close. 5-minute chart. All right, so we have London open kill zone, optimal trade entry, sell side imbalance, buy side inefficiency, institutional order flow entry drill. It's not annotated. I'm just calling it out because it's not in your chart. I don't want it to be too cluttered. Breaks down, displacement again, consolidation in here. Watch what we do when we add the 5-minute chart annotations. Sell side imbalance, buy side inefficiency, trades to it here, sells off. Your gap and breaker, high, low, higher high, the down close at the low, extend that out in time. Breaker, all of this in here, yeah, it's you can say you could be a short there. But look what happens when you get into New York and it's in the breaker. So it's in this shaded area, which is this candle's close till it's low. Let me take this over a little bit so you can see the wick on that. See that right there? That's what's happening right there. So that's what I'm drawing your attention to, extending it out in time. Why am I calling this? Because that gap is important. I'm going to use that because it may not need to go deep into the body. If it didn't have this tail or wick on the low end of the candle, then I would use the entire body of the down closed candle that makes the breaker. When do you use the wicks and the bodies? See, they come out in the commentaries. Time of day, New York open with the optimal trade entry and the breaker. Does it drop down here? Yes, it does. But doesn't it drop more meaningful and more magnitude and speed here? Yes. Why? Because the first element of algorithmic theory is time. Time for it to move. When should it move? When it trades to that breaker in New York. When it has traded to above fair value or equilibrium. We have the high, the low, it trades above 50% of that into optimal trade entry, into the breaker at the time of day when we expect a continuation of what has already transpired from London. London open kill zone back here. What was price doing ahead of New York? Going down. So you want to use all these ideas to frame a trade. What direction? Lower, because London's already shown itself wanting to go lower. Once again, redelivered rebalance. Frame it with the previous candle's low, next candle's high, institutional order flow entry drill, sells off, offset distribution. When does it occur? London close. Beautifully. All right, here's the British pound versus US dollar daily chart. And we're going to add the monthly levels. We'll go out to a monthly chart and show you what that is. We have the old high back here. And if we happen to go above that, I'd have to refer to that at that time. But right now, I'm just calling this as the only real important level on the monthly chart. Weekly, we're going to look at that on the weekly chart. SIBI, sell sign balance, buy sign inefficiency. So we've traded up. A little bit more would allow for it to close in that. We'll see if it wants to get up there at a later time. For right now, it's in a retracement. Pull up the daily levels and put it on the daily chart. Daily chart is showing the fair value gap here, low and high, buy sign and balance, sell sign inefficiency. And if we do drop down into the fair value gap, that would be a level I would watch for retracement higher. We have a bullish order block here. It might be showing some sensitivity there. I don't want to pick a top in this currency. I've already said this many times, but I'm going to take the level off on the monthly and on the weekly. And that's our daily levels. And dropping down to the hourly chart. Here's the hourly. And we have a smaller one balance there. We have one there as well. Sell side liquidity tapped into that already. So let's look at the hourly chart annotations. And this is the April 24th, 2018 mean threshold of the bearish order block of that particular day on the daily chart. You already know about that from the previous annotations and discussions. Again, this is that imbalance I'm showing. It came down almost about 99%, completely closed that in. And we're showing some retracement in here. I don't have anything that's obvious that it may be looking to reach up into, so hands off on this one still. But if it does break down, watch and see if it wants to go into here. If we get that run into that bearish order block on the daily for dollar index. And I'm not sure what this is floating around out here for. Let's see. Yeah, I'm not sure what that is. It might be something I gotta get rid of right there. So we'll do that. So 15-minute time frame, we're gonna drop down into that time frame, and you'll see again time of day, London open, high of the day, New York open, continuation, low of the day, and London close. Okay, and let's make it a little bit more data there. Now, if you look at this high down to this low, and you measure that on a fib, we trade above the 50% right here. So it's trading at a premium. Offers opportunity to sell short, and then you have breakers here extending out in time. You can see that as well. We're going to add the 5-minute annotations now on a 5-minute chart. Scrunch this up a little bit. Okay, and I'll take the 15-minute time frame off so you can clearly see what's being shown here. I'll toggle the 15-minute back on to show the kill zones, but for right now I want you to see we have a mitigation block, which is high, low, lower high, breaks through it, down close candle, extended out in time. So that's the level inside of the fair value gap that's being defined here. You see that? Let me make the chart bigger. Okay, so we have this candle's low, extended out in time. That's your mitigation block. Perfect. Perfect. Inside the context of potentially trading in and closing this fair value gap, very minimum, looking for a rejection block on here, and maybe this the sweep of the buy side liquidity above this high. It does that as well, but specifically goes right to the mitigation block. Sells off. We have the mean threshold of this breaker. All these down close candles here, 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 all 4 of those candles, all those consecutively make up the bearish breaker. Why not this one, Michael? This candle here is the bigger one. This is all one consecutive down close candle in my mind. Okay, it's all one time period. So if we had a 20-minute chart, this would be one single down close candle on a 20-minute basis or interval. Even though this is a down close candle, all of this consecutively has more narrative in my mind than in one singular candle here. Okay, and why not this one, Michael? Because the body doesn't go lower than here with more than all this. No, it's just one single candle here. I'm using the narrative of all of this being pushed down deep. They may need to come all the way up into that range eventually, okay, but if not, mean threshold. Well, split that range in half, extend it in time, you get that here. So we have the mean threshold of all of this range. That's what's trading to here, and it's also trading to the fair value gap. So it's consequent encroachment of the fair value gap and mean threshold of the bearish breaker in the context of lower prices. And we have the 1.3850 or mid-figure level. I mentioned and taught you that if we do sweep through big figures, that it can go as many as 40 pips. When we sweep mid-figure levels, it can go 20 to 30 pips, but generally 20 is about what it looks to do. And we traded down through the mid-figure here, came back up, offered another selling opportunity, and then runs the low and goes right down 20 pips below the mid-figure. Hits it beautifully, and then we have the reaction there. Now I'm going to add the time of day kill zones again, so you can appreciate the delivery of price, and take off the 5-minute. So here's that New York continuation into London close, and add that back on. You can see all the annotations there. This is the mean threshold of the last up close candle, which is the bearish order block. Optimal trade entry there for a scalp. So you could be a seller here and cover below this low here, and if it's going to run 20 pips below the mid figure, add some pips to that for spread, and that would be an objective. So shooting for 55, covering at 35, that's 20 pips. That's a setup. That's an intraday scalp. So how you want to frame your particular setups is up to you as you go through the mentorship. You'll be able to see many setups that you wouldn't have otherwise seen. And you can see where we are now, trading back up into that 15-minute fair value gap. So hopefully you got something from this one. Hopefully you got some greater insights, and if not anything else, you can see a greater degree of time and price theory being delivered in these currency pairs. They repeat. It happens daily, over and over again. Sometimes there's a slight little variance where the low of the day doesn't necessarily form right inside the London close. It might be a little bit early, or it might be a little bit late, depending upon when the economic calendar has certain events. If there's a real big economic driver that happens early on in the New York session, sometimes it doesn't deliver all the way to London close. It'll be a little bit early, especially if we get into Thursdays and Fridays of the week. Okay, earlier in the week, it generally tends to line up like that, where it will create the opposite end of the range in the London close time window or kill zone. New York generally is a repeat in the same direction of London Open. Not always, but usually. Okay. And I think that's going to be enough for today, and I will touch base with you tomorrow. So until then, be safe.